What is happening in the markets today? Why did we not have the usual VIX Crush Friday? Have you been asking yourselves those questions all day whenever you see all this red within your portfolios? Let us take you through this video today to tell you why exactly this is happening. Is the market going to keep going down from here? And what are some indicators that you can actually look at to decide how much danger is there really in the market and how much possibility of a correction and how far could it go? Today's going to be a super fundamental, informative learning, teaching video. This is the first one we've done on the channel. We're going to start a big series of this to inform you how to be a better investor and to how to have confidence in your investments and not have to rely on people on CNBC or the news fear mongering or telling you everything that is happening in the market. Or if times are in a euphoric bull run, you can understand and be like, hey, this doesn't look too right. Let's get right into it. As you can see up here, the markets has a huge red day. All the indexes are down by over 1% and ended the day down even more after Trump's comments about the war in oil. And we're going to get right into that in the video. So that's the number one topic. Then how are we going to monitor investor psychology in the market to discuss if, hey, can this market get lower or are people already bared up? Three, we're going to get into a sector we think that's super, super undervalued right now. And is SaaS making a comeback? Or is this more of a consolidation for a down run and it's just a bull trap right now? And lastly, how should you approach a market like this where so many high beta stocks are getting killed even though the market is only down 1.5%? We're going to give you a few tips and fundamentals that you should do to be confident in any singular market. So, like we said, we're getting into why is it so dangerous? Now you see the GSG spiking to over $30, ending the day up even more. And its oil is up 34% this week to over $90. This is so dangerous for the market due to its profound impacts on inflation that it can have. GSG is oil has included in it, and that whole index is actually included in the market basket for inflation. So, for example, say the rest of the market actually has a little bit of deflation, but you have this one part of it that goes up by 30+% in the month. That's going to make inflation go a whole lot higher. And just think about the situation today. We had a jobs report come in where you had a decrease and unemployment went up to 4.4%, while you possibly could have a huge inflationary increase from these aspects. Trump wants these rate cuts because he sees the problems in the labor market, but this puts Powell and the Fed in a problematic place because you might have inflation going up at the same time due to rising oil prices, which make companies more pricey to ship items, which means they have to price them as higher and it's passed down to consumers. And whenever there's no rate cuts, we even might have rate cuts in the possible picture if this keeps going on for a while and these prices keep going up. These hikes, like 2022, if you remember what happened, the market tanked after them. And this is a market that actually almost needs rate cuts to keep going higher because of the cracks in the labor data, and it's going to help in the modeling decrease the discount rate factor. So this is something so dangerous to look on. A lot of recessions are actually preceded by the GSG going up because of what they do. Whenever you raise inflation in the market cycle, you have rate hikes, credit gets tighter, there's less liquidity, and then that in turn makes equities look less valuable, and people start running to yields in bonds or keeping money off the side and don't want to invest because they're scared within the market. And companies' earnings go down because people feel like they don't have as much money to spend because prices are going up. And that creates a huge drawdown effect, such as the one you saw in 2022. So the GSG going up is very dangerous. It has preceded many recessions, and it's something that you should look at on a daily basis and has been so scary for the last few months. Let's look at some other fundamental-wise psychology things within the market after we got through the GSG and oil. This is more of the teaching moments, even though that was a pretty good teaching. These are really what you want to look at that can apply to any market circumstance that aren't just going to be at a GSG or an inflation crisis. These next indicators are going to do like the put to call, fear ratio, greed index, or the VIX, or the AAII investor sentiment. These are all important for a market in a bull run or a bear run. So that's really important that you pay attention to them. So the put to call ratio is basically how many more people are putting puts in the market than calls, because if you know something about the market, it always goes up over time. So people are overly bullish. So at times here, you see this in April, whenever the put to call ratio got over 1 is insane. That's a unbelievable buying opportunity because that actually means more people are selling puts than calls in that specific time in the market. And that's unbelievably bearish because if you know everything that we always say, the crowded trade never works out. So I want you to almost envision, go back to last April. Everybody was bearish. You talked to everyone in the markets. They thought it was going to keep going down, right? Everyone starts getting bared up, thinks they're going to follow the trade, the crowded trade, after the trade already happens. So at the trade already happened, the market made its down run, and people are like, oh, let me get in at the end and make my money back that I lost on the way down. Well, guess what? They got short squeezed and lost all their money. So something you want to do is, if you see a sleepy put to call ratio, you should be plus a high forward P in those on the market, and everyone's euphoric and bullish. That is a red flag because it means no one's really hedged to the downside. But if you can see other times like this right now, look what happened to this right in November. The market had that 5% drawdown. Put call ratio got over 0.80. Anything over even 0.7 is like a little elevated. 0.8 is elevated to the point where you could get a reversal off of that if there's a downturn. 0.9 is extremely elevated. And over 1.00 is usually at the bottom of these huge 30+% recessions or crashes, like the flash crash that happened in April. So over 1 is almost always an unbelievable time to buy, because whenever this put to call ratio is over 1, there's almost no one left to turn bearish in this market, and people can only reverse the other way to bullish. So I just want you to take, that's the main message you're going to be with all these psychology things today, is whenever everyone is on one side, there's no one else left to go to that side. So if people are overly bullish and not taking any risk, it can honestly almost only go down there because equity valuations might be maxed out, and vice versa. Whenever you see a high put call ratio, which is 0.83, I've seen signs it's gone up to 0.9 today. That's whenever you really want to be buying almost and more assessing the risk and what could happen in the economy and what's going on, and just thinking in your head, if everyone is playing like this, psychology wise, you got to play that game and say, hey, it can't get this much worse because it's already gotten this worse. So that's a great indicator that you should be looking at almost on a daily time frame to hedge your risk, or if you really should be buying and seeing how much cash you keep on hand or anything. Another huge indicator is the fear and greed index. So basically, if the market goes up, people are overly bullish, it's going to go into greed. Whenever people are buying extra and extra stocks, it's people are greedy, and the RSI is going up high, and stuff's almost not overbought with the greed index, but people are just buying exuberantly a lot of it to the point where everyone's very bullish on the market. And consequently, whenever people are selling a lot or stocks are going down, at the April lows here, you got to an extreme fear of 3. At the November lows, down 5%, 6. Right now, you're down to a 26, even dipping further and further, which the index being this low, even only on a 1.5% move in the market, makes me think that this is not going to be that much of a sustained move, because I think people are worried about it going long. The Pentagon has been saying it's going to go to September, but personally, I think Trump's going to end up fixing up this and end the war very soon, just because of the effects on inflation. And so this is another example of times whenever you see this indicator super low like that, great time to buy from the market, because there's only 3% people who are still a little bit looking towards the upside whenever it's at 3. So at times like this is really whenever you want to watch these charts and monitor investor psychology, say, hey, a bounce could happen right now because this is so oversold and it's went past so much of the fundamentals and the swing in the market almost on a pendulum. Whenever you go overly bullish, if fear and greed is going to be up here closer to 80s, 90s, and if it stays up there for a while and no one's really taking a risk, credit's loose, and spreads are really loose, then you're like, okay, maybe I should be taking a little bit less risk. It's been too good. We could get something to come to the downside. Doesn't even need to be a black swan at that point. It could be a fundamental thing. But whenever you have a fear and greed index at like a 26 or something like this, even a little bit less than average, it's going to take a black swan, which you're really not going to bet on a black swan happening in the market, because you want to bet on a probabilistic mindset where maybe there's a 5% chance a black swan happens. So you want to take that 95% odds, but still always be prepared for something to happen, have that extra cash on hand. Because usually if a black swan happens in the market, it's going to come up pretty fast after that intense drawdown. So this is the second one of those great indicators I want to look at, just investor psychology. Another one is the VIX, the volatility index of the market. So it's basically how volatile, how much people thinks the market is going to move in the next few days or so is what this indicator is saying. And whenever this spikes up high, it's usually because there's insane selling pressure because the market's dumping so fast. For example, look all the way back to 2020 at the bottom of that, right as it reversed all the way back up, the VIX got to 82 because that was such a little flash crash. Look at here. In April, it got up to over 50. Anytime you see the VIX above 30 is a great time to buy. 40 is unbelievable time to buy, and 50 plus is load the boat, all out, no cash in your portfolio almost, because it's so rare for it to get that high. So if you see that, that's a generational buying opportunity that you have to take advantage of. Even though all your sensors are like, don't buy, you have to take this and not feed into the crowded trade that many people are saying. Like your friends might be saying it, your family might be saying it. Everyone's like, oh, my portfolio's down 30%. No, that's the best possible time to buy in the market. Just like Warren Buffett says, whenever everyone is fearful, be greedy. And whenever everyone is greedy, you should be fearful, is the whole psychological point of this aspect. Because whenever you have a crowded trade, you need to understand that it's not going to probably play out 90% of the time. And if it does play out, it's not going to run that far after the crowds happened. Maybe the only time that really the huge crowded trades happened was GameStop, but that stock, GameStop, was one singular stock. We're talking about a whole market with trillions of dollars in market cap, so you can't just have a whole retail group go and overpower everything. So that's just another tool to look at. And look at this, whenever you have a sleepy VIX, you could get huge spikes up. Like look at whenever you see the VIX is sleepy, even coming into pre-2022, it was not too crazy high, sleepy, and then it just peaked above 30 a few times in that year, just as the market sold off a lot, and it was a year-long run, so it stayed above 30. So just think about that. An elevated VIX usually means great times to buy. The market can obviously run a little bit farther or longer if you've an elevated VIX, but you're going to be getting stocks at a discount, and you should be DCAing in them regardless of whatever happens in the market. So just remember that you don't need to all buy at once, and you don't need to time the bottom. Like you can see 2022, it went above 30 a few times. So if you were buying it every single time and waiting for more and more dips, you're amazing in the market coming out of it into 2023, 2024, and hopefully you're ready for that 2025 crash. So that's just another psychological thing to look at. And you can even make a checklist. Hey, if I see the VIX is up, the fear and greed index is super greedy, extreme greed, the put to call ratio is super high, you think the market's probably going up? It's going to go up, but you don't know whenever it's going to go up. So that's just a good time to look at it. And then the last thing I want to show you is the AAII investor sentiment. So even before we get into this basically measures how bearish or bullish people are for the next 6 months. What do they think the market's going to do? Look at this whenever the 1 year bearish high was, to illustrate our point. The week of April 2nd, the market bottomed April 8th. So that week that they did the investor sentiment was whenever the market actually bottomed. Whenever people were the most bearish that all year was at the very bottom of the market. You never want to follow the crowded trade, and you need to have cash on hand to be licking your lips for any time something like this happens, so you're always prepared, and still being value stocks and dividend stocks, so you're making money on the way down. Have a well-based portfolio based on what the market conditions are. And then whenever you see the market tank, that's whenever you want to get into a bunch of growth stocks, because they're going to be the first ones that explode out of there, because those high betas are going to get beat up. But this here, you can see that people have been super bearish this year, way more than the norm, which is actually very important to see, because it makes sense that there's almost more upside that you think to the market could be happening, just due to the fact that you have a lot of people bearish and people are a lot wrong. And if anything, we think the market could just chop for a while, because look at, no one's really that neutral. People are on both sides of the spectrum here. So people are almost saying, hey, we think it's going to go one way and have a big move, but it could just keep chopping like this for a long time, because no one expects that. Like we said, the trade that no one expects is usually the one that works out. And that just brings us to our next point in finding the SaaS stock, which has been sold off so much and so undervalued right now. That look at these huge players and what they've done the last 5 days. Even the market's gotten destroyed. Adobe's up 10%. ServiceNow up 18%. 18% off those bottoms. It was trading at under $100. Now it's $124. Salesforce up 5% in the last 5 days. And look what Zeta, a stock that we love, we've been talking about and preaching about, up 16% in the last 5 days after their beautiful earnings. Look at the IGV, how much it was trading at, and it made a bounce here. just from a little technical side, we don't do much, but you see a lot of bottom on some a lot of volume that kind of will mark a bottom. Look at this here, right here, a lot of volume, big volume candle. So if you see a lot of volume on something, I'm not saying we don't do TA that much, but that's just a little trick that you can think that you should never just base it off TA. But usually, whenever there's a lot of bottom, it means a volume on something. It means a crazy reversal is happening, and it even came down and got that liquidity. But mainly just fundamentally wise, Wall Street was selling us off for no reason. AI is not going to come in and take this. You have all these companies that are so integrated into companies. For example, Salesforce, they have every part of the companies connected through them. All their operations run through them. They connect, I don't know, treasury departments too. If you're a manufacturing departments, they connect all of that and allow them to communicate, organize their data, and say, hey, like, if I'm running a lemonade stand, I need to see like how much money I'm buying, how many products I'm selling, how much more I need. So they tell companies that. ServiceNow and Adobe and Zeta are also so integrated. Each of these companies has all this first party data that they can combine with AI. Even Salesforce and ServiceNow are used with Anthropic. They use them in tandem together, which makes you think that they might actually be huge beneficiaries of this AI because there's going to create so many more use cases for these companies, so many more use cases for someone like a Zeta who's been using AI for the last 10 years and collecting all this data that now paired with AI helping answer makes the company so much more productive and gets more generative. And just take a look. If you go and you try to do a picture with AI, you have to do it 20 different times to even get a half decent picture. With Adobe, that's a small sector of their business, but these companies just go and try to do with AI. AI is good right now, but most of the stuff you have to do by yourself, and these companies are not going to be effective for the long run. And you're buying them at deep discounts right now, up to like 40%, 50% off their highs. So there's so much upside coming for them. And that's why you see them being so strong in a market that has gone straight down and chopped around with all these other higher names recently and these worries with the war because they've been so sold off and people are kind of realizing, hey, we should be buying these companies. And now what we said, what should you do in a time like this and how do you approach this market? You should be buying as many stocks as you can get, obviously keeping a little cash in case it goes worth. But if you're getting these companies at 40%, 50% dollars off, think of it like socks on a Black Friday sale, right? You go to the store and you find your favorite clothes 40 to 50% off because it's Black Friday. What do? You buy them because they're the exact same clothes, maybe even better at that point, and you know, hey, they should be valued right here. So why would you not apply to the same thing to stocks, right? You see a company that you believe in their fundamentals, their CEO, they have great balance sheets, so they don't have a lot of debt, and they're consistently beating every quarter, so you can project out numbers and growing, fighting off other companies. That's exactly what you want. That's exactly all these companies. These are our companies we've been buying through this dip because we like them that much, right? A Zeta, we have them going from $18 to $45 this year. And over the next 4 years, we have them 6xing as our base case just because the point they've gotten oversold, that you can get these huge gainers on these companies because people just write them off and follow the crowded trade like we've been saying all day. Whenever something's getting sold off or the market's getting sold off with good fundamentals, you want to be buying because in the short term, people will panic. But if you're a long-term investor, none of that should matter to you and you should actually be happy about eventually this happening. A SoFi like we have. Over the next 3 years, we have them 4xing. This year, we have them doing a double up from right here. Their CEO just bought shares at $18. Does that just not say confidence to you in a company like anything else? A Celsius, we have them going to $95 over a double up this year. They've been getting constantly sold off this last week or something after they came out with unbelievable earnings, 30% beat on EPS, beat on revenue, better guidance than thought with the rest of the world. And they went up to 60 and they got sold off to 43, lower than they were pre-earnings for absolutely no reason. We have a 5x over the next 4 years and you should just take advantage of this. And the best part about Celsius is it's a business model with the drink market. Think about how many people can get these every day no matter the economic circumstances that you're not going to have to worry about the economic cycle about, and they can actually provide you value and defense if the market goes down. In a recession where you might have that money, they might go up, get closer to their fair value, and then at the bottom you can just put it into your growth stocks and have those explode out of there and 2 to 3x out of the recessions in that time. So it's a great hedge and help for your portfolio. And then our other biggest stock that we have is AMD with a 2x this year and over the next 4 years a 5.5x with an unbelievable CEO in Lisa Su. Not even a crazy P ratio, which is giving you a peg of less than 4, peg of less than 1 with them. So they could even be valued higher in that semiconductor space that companies usually trade at higher multiples. They're just getting sold off because everyone's worried about AI right now. They're not going to need GPUs. They're not going to need this infrastructure. But like we said, everything's going to work in tandem. Stuff is going to become better. They have their MI450 chip coming out, and we see them running to at least $400 this year. Is what we're pretty confident in them that they can do by the end of the year. Whenever the hype cycle starts for these companies, whenever the hype cycle starts for Zeta, SoFi, Celsius, or an AMD, that Wall Street gets back to being confident in them, even though their fundamentals were getting better the whole time, then you're going to see the stock prices rip like anything. These companies are almost in recession of their own before the market's even gone down. They're going to be very resistant to anything happening, just like the SaaS sector is doing whenever the market has been selling off all these other huge stocks, because they've already had their sell off. A lot of these stocks are already down 30+% from their all-time highs or where they were at a few weeks ago. So they've already had their correction, and the only way you're really going to get them down is a 20% correction in the market, which during that time, you're going to have more cash on hand at the very bottom, and you're going to be buying up at every time during the market. So if you like more of this, just leave a like and subscribe, and just get ready for all these other tools that we're going to be bringing you to show you how we can do all these projections to save time. And ask yourself a question: do I want to become a more confident advisor and trust what I think? Do I want to fulfill my dreams in life and buy that house, go on that vacation, provide for my family, have my life better, do what I want to do, not have to work all the time? Trust us and learn the fundamentals of the stock market, because this is the best thing you can ever learn for yourself in life, to be constant in controlling where your money, even if you have someone else helping you. You can say, hey, I like this, I don't like that. Take control of your life, because your money is almost like your family. It's your most possessed asset, because your money is going to help your family achieve, and them going to do better in life and create more experiences for you to bond and grow closer with people. And it will help your overall likelihood. And people say money can't buy happiness, but it can buy you safety and your calmness in life. So just understand that we're going to be helping you guys on here, giving you guys more research, more strategies you do, stuff you can pay attention to the market to make yourself a better investor and stand out, and bring you an amazing software that is everything is being developed right now, that is really going to complete the journey for you and give you that time that you never thought you would have to really become that investor, and help you do it faster than people realize.